Alright, the S&P 500 finished 8 points higher today, but on very, very light volume and well off of its highs as we close with a little bit of selling into the close. So I'm going to put this near-term volatility that we've had into some context in today's video and tell you what you should be watching for before we really can decide and make trend trading decisions in our active trading portfolio. We're also going to take a look at what's leading the bounces, what's leading the declines, how that may impact how we trade and where we trade. We'll head there with our trade idea for today. So let's go ahead and get started. Today is Wednesday, November the 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator, as we always do. You can see we have, with a drop at the very end of the day today to close at the low, we finished with a bearish posture before Thanksgiving here. We have a oversold momentum line. We have an oversold short-term sentiment. You can see it's been a while since we've been bearish heading into Thanksgiving. You can see we were pretty bullish last year heading into and coming out of Thanksgiving. A little different story, obviously, this year. Bearish near-term high, lower near-term low point. You can see here, so here's the low on this one right here. So this be this low point, and then we bounced, and then this is obviously a much lower low point. But the near-term line is actually showing higher lows on the near-term line, on the blue line. So potential divergence again, very similar again to this end of April area with the bullish divergence that we had there as well. This one did not get to oversold levels, so that's a key distinction. And the intermediate posture wasn't this bearish. We are a lot lower. But market sentiment was, down this low as well, and we'll see if we pop out of it with a bullish move like we did May 4th of earlier this year, where we rallied higher. So we haven't got that long lower shadow on the daily chart, and depending upon where we close Friday, we've had last week was a long lower shadow, but might not get one this week. So pressure, but we still haven't broken through that 2600 level. Still a lot of near-term volatility here because of how deep this initial pullback was coming off of that divergent high point. If you take a look at the Dow Jones Industrial Average, looks very similar. Oversold momentum, setting up for a bullish divergence. Then the high point about 25,500 for the target on that near-term divergence. Same thing here, big time bullish divergence showing up as well, with a potential, close to a bullish cluster. Our intermediate line is almost down there below 20. And then same thing here, bullish divergence setting up, potential for a bullish divergence. There we go, on the Russell, bullish divergence there. A little bit of a Harami pattern, again, trying to hold that low point where we got all those clusters back here. Very, very important, as you can see, across this chart, to hold this low point for the Russell 2000 with that divergence. We'll see if that ends up being the case. So some... and again, very low volume, and even yesterday was not as big of a volume move as we had, but short-term oversold conditions on this last couple of days, more oversold than it should be according to what the near-term line is telling us, the blue line on the market forecast. Of course, the posture is strong, is really close to being. In fact, on this one, you almost have all four lines showing a cluster, which is very rare for the Russell 2000 to get all four lines. If you go back in the day here, let's change to a 10-year chart, and you look at all the clusters, you can see it's not too often that the orange line, see the orange line bottomed out about right there with those clusters. Same thing here. A lot of these clusters in 15 and 16 during the last death cross, we came close right here on the 16th, right there. We came really close to having all four lines, including market sentiment below, and then you go back to over in this area, market sentiment line did not get below 50 there, and then you can see some of these others in a lot more obvious. You have to go back pretty far to get to a point where you have a cluster. Even on this pullback in 2011, right there on that day, you had all four lines. This was October the 3rd of 2011. So October 3rd, 2011 was the last time we have clusters on the October 3rd, 2011. It doesn't let me do that, so it's going to go right here. So right in this area. Whoops. So let me do it here. So it's going to be right in that area, and you can see. Oh, it's not going to let me do it, is it? From October the 3rd. Alright, so if I go here on the weekly chart and I go to the bottom, give it a second here, all the way up from that bullish oversold cluster back in October of 2011 up to the bearish cluster we had at the market peak this year, the overbought cluster, excuse me, on a weekly chart. The Russell had gained 187% over the course of what 2,500 days, so 360 bars. Annualized percent per year, you see it up there at the top in the middle, 27% a year return from October 11. So that's what, 1, 2, 3, 4, 5, 6, essentially 7 years. 27% return over 7 years. The last time we had an oversold cluster with all four lines on the Russell 2000 below the 20 level. So we came really, really close to that here with this little drop. Of course, it's also been since 2009, so even earlier than that, that we had this many clusters, oversold clusters, clustered together in such a short amount of time. So, you know, this has been, as you know, it's maybe not a 50% drawback, but in terms of how oversold it is, how fast it is a very it's a very noteworthy pullback that in the past has sparked some pretty decent rallies over a long term. And you can see right now you got a little bit of a double bottom pattern, potential double bottom. It doesn't form until you break through this high, but you got the potential of a double bottom forming here that definitely will keep an eye on. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Click that Market Scholars logo right here in the bottom right corner of your video. Click the red subscribe button that pops out there. Also, click the thumbs up icon that's down below the video. That lets us know you want us to do the video again tomorrow or Friday, right? That you want us to keep doing. A one-click way to give us feedback. You can do that right now while you're watching. Also, further down below, comment on anything that stood out to you from tonight's video. What did you get out of it? What questions or comments do you have? You can comment down below. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Also, follow me on Twitter for more content like this throughout the day, and join our Market Outlook community that we created on Facebook. Also, you can watch our Market Outlook video on our blog here. You can see our schedule for our classes. You can see we're canceling our classes for the Thanksgiving Day holiday. So our last one is what's going on here this evening, Strategy Lab with Brandon. And then we go back to Monday, our normal scheduled class for top-down trend trading. If you also notice, again, 3 clicks tell us you want us to keep doing these videos. Number 1 is to click this heart right there. It opens up your Market Outlook tweet on Twitter. You can click that like button. Number 2, click on this image. Takes you to your Facebook page where you can like tonight's Market Outlook post there. And then number 3, click on that 3 buttons. Again, you want us to keep doing these videos, click either one or all 3 of those. If you don't want us to keep doing them, then don't click anything, of course. Alright, so back to the chart. You can see how this week is shaping up. It's a bearish. We know we're so far, again, that the long lower shadows, the low can hold as a support on the closing basis. This one's still there, but not last week. So depending upon where we close today, closing above 2670 will be important to hold that low point on an intra-week basis. Of course, if we finish at this low, more than likely we're going to get that death cross next week. And remember, it's not there until we close the week, but you can see that we're a lot closer on the S&P. We are now forming it on the Dow, or excuse me, the Nasdaq, and then the Russell 2000. You can see we've had for a couple of weeks now. So we're getting that death cross, which typically, remember again, the last time we had the oversold cluster was October 2011. Right there, we got the oversold cluster similar to what we have right now. That's basically set the low point then, and we have, like I said, a 27% rally, including that pullback. a 27% annualized return every year for 7 years since then. Now, I'm not expecting us to get a 27% return going forward for the next 7 years because of the late stages we are in the cycle. But this kind of shows, again, how oversold we are and the opportunity the rare opportunity that provides us, if not for a 7-year trend that was kind of broken up here in the middle. But more, even if it's just a maybe 1.5, 2-year trend, again, the Fed hasn't stopped raising rates yet, and the market rallied for another 1.5 years after they raised, or almost a year plus after they stopped raising rates in their last interest rate hike cycle. When you look at the 3 red arrows, of course, we got 3 red arrows still on the S&P, MACD, stochastics, moving average. In fact, they all look very similar, 3 red arrows in all 4 of them. When you take a look at the 2-line version, again, how far below the 8-day moving average we are. In fact, we're close to getting a pretty decent divergence on the MACD and the stochastics, even if it's a double bottom on that. If you take a look, if I were to change that MACD right here from the 8-day to looking at where we are relative first to the 30-day. Well, let's do the 8-day first. How where we're at there, and you can see we've been gradually kind of getting further away from the 8-day. We've been going down to slightly lower lows here, but the 8-day has not been pulling as far away from the movie, or the price has not been pulling away as far from the 8-day moving average. Now, if I were to look at it, how far away we are from the 30-day moving average, of course, a much bigger divergence setting up there, much higher low point here, and again, that's how far away we are from the blue line compared to where we were here. So we didn't get a divergence on that here, and we are right now with this kind of double bottom that's playing out. And again, if I were to look at the Russell 2000, you'd see a very similar story. Again, double bottom with a much higher low point on both the MACD and the stochastics. MACD here, in this case, being again how far away we are from that 30-day moving average. So kind of a stealth convergence going on here after this big time pullback away from it initially earlier last month. You can see for the most part today we were rallied up to that 267, basically last week's high point, right there at these lows, yesterday's high point, last week's low point. That's what we were hitting our head up against today. Very light volume, pulling back at the end of the day. Again, heading into a day and a day off. So the markets, investors are getting closing positions ahead of that holiday. But again, just keep in mind, so lower high, well, first of all, equal high and a higher low point. So not that bearish of a day, but not bullish either. But when you look at the volume for today, let's go to this one here and pull up SPY. So the trading range was less than half, just over 2 points. So below 1% on here. 2.65 is 1%, so below 1%. And then the volume at 75 million. So again, put that in context here. 2 points is way down here. 75 million is way down here. And then of course that's 1% move today, way down here at the bottom. So it's bringing a lot of these averages down. But again, it's a holiday. We're going to get a day like that Friday too, because it's only a half day, and it's also going to be just like today. Probably could have been a half day, and we would have just been fine. From a volatility standpoint, not surprisingly, volatility fell for most of the day. Fell back down towards 20. Little pop at the end with that sell-off, but not much of one. It's in the bearish territory still holding 95% for support. But every time we're bouncing, we're not getting to extreme levels anymore like we did over here, and then the initial surge up to 115%. So the VIX isn't bouncing as much relative to its longer term counterpart, which happens when you're a lot more bearish. We had the surge, and we're still in the process of moderating. Of course, you have to break 95 and break 90 to get into the bullish zone before we're really solidified this bullish bounce that we're on. Alright, to summarize, the markets continue to be bearish, continue to show some short-term volatility in the near term, but not enough of one yet to really start a bear market. Not by the definition of how far down we are, but by the definition of an extended run below the 200-day moving average, where the markets and the economy goes into a recession. So we're not to that point yet, because we haven't broken some major levels, and in fact some of these indexes are showing us patterns that have sparked some pretty decent runs in the past. Of course, until we break out to at least new near-term highs, or break down below those significant lows, all we're going to get in the short term, both to the upside and the downside, is just volatility. And so don't get wrapped up too much into the big moves, because they're going to be relatively bigger because of where the VIX is right now. But that's all they are now until we get a clear break one way or the other. And of course, it's got to be a break that holds, not one of the fake outs, which ends up even being more bullish or more bearish if we get the fake out to the upside. So what do you think about that? Do you agree with that posture, that outlook? Do you disagree? Click the poll that's popping out in the top right corner of your screen. Hit either agree or disagree. Scroll down to the bottom if you clicked on disagree, and let me know what you see that would suggest otherwise. All right, looking at today's moves, you can see is a little bit of a risk on day, but big time grain of salt here, because very, very light volume. But all your equity asset classes ended up higher. High yield bonds were up to, preferred stocks were rallying. They did well. You can see gold was up with a little bit of weakness in the dollar here down below, and long-term bonds. Everything else relatively flat. And then, of course, crude oil bouncing. Now, if I were to change this out to just look at this week, right, so far this week, you can see crude oil started the week down, but then rallied up, and then, of course, yesterday and today is so far down 4.5% in this week's 3 days of trading. The S&P down over 3% in 3 days of trading. Whereas on the other end of the spectrum, you have gold and the dollar and long-term bonds all showing gains, with high yield also outpacing preferred stocks to the upside. So a typical risk-off pattern for the last 3 weeks. If I were to go last 3 days, if I were to go for the last 2 weeks, right? So we'll come over here to the 8th through the 21st. So here's a 2-week chart essentially. You can see again, crude oil down almost 12%. It was down 14% yesterday for a 2-week period. You can see stocks down about 6% for this 2 weeks. And of course, bonds up 2%. The dollar's up and gold's up. If I take a look at how bonds are performing, let's look at the weekly chart on the 10-year yield. You can see we're starting to form some kind of a reversal pattern here, coming below that 50-day moving average. A little bit of a divergence here. We've got the divergence with those highs, another lower high with higher highs as well. So we're diverging on the 10-year note. Now keep in mind, the 10-year note and especially the 30-year note is the reflection of economic growth expectations. Once you get to the smaller term yield curve right there. When you look at the smaller yields here, these are the short-term yields. They're going to be more in tune with or in line with Fed rate hike expectations. So they're still rising. They're not falling like these longer-term yields are. They're still relatively flat, and the yield curve still hasn't inverted yet. It's close. It's a lot closer than we were earlier this year, but not to the point yet where, again, the yield curve inverted about a year before the Fed stopped raising interest rates in the last rate hike cycle. So you can kind of see that despite this volatility, we may still be a while away before we really get any significant change in monetary policy. A lot of this move is tariff related. A lot of this is economic growth related or expectations. But they're all expectations. None of it's actually played out to, and we still have GDP that are sitting about 2.5%, so down from the original 3% that where we were, but still, 2.5% with the lower durable goods orders that we had today. So if you look at the durable goods right here, that was our biggest release that we had. Here's the annual year-over-year growth, and we had pulled back on the annual basis last month. And this month, a month-over-month basis is pretty negative. But if you go back to last October, we were negative there too. And you can see, previous Octobers, we had one bullish one. That one wasn't so bullish. So maybe a little bit of a seasonality there, but the year-over-year figure not as changed and still relatively strong despite the pullback. And you look at the economic surprise index, which is still positive. It's not very strongly positive, but you can see it's a lot more negative across the globe than it is here in the U.S. And if you look at rate hike odds, are still relatively high for December, close to 75%, though it's 80% is really kind of where you're set in stone. It's the March rate hike odds that now continues to trade below 40% for getting that rate hike in March. So the market's not so convinced that we'll get another rate hike coming out of December. So that's going to make this, it's a month from now, but that's going to make that meeting very, very important before we head into the Christmas holidays. Crude oil has formed its death cross. We've seen this before. It made its return move and it couldn't continue the declines back here in April and July. So now we're getting the death cross again. Is this going to make its return move, back to the 200-day moving average, and what will it do there? Back here, we were so high when we got the death cross. We made a return move to the 50-day moving average and then fell down. But we had a lot more room to fall there than we do now because we haven't recovered as much of that yet. A lot of that dollar pressure has held back the gains in crude oil that we still continue to rally throughout most of this year during the dollar strength, but it's given back a lot of those gains here as well as it should. Remember, a lot of these foreign markets have also given back a lot of their gains with the strength in the dollar, and they've been struggling, right, to say the least. Doing much better on a 3-month basis. A few of these, Turkey, which was really so beaten down, Russia, and of course Brazil. But you can see some of these other areas, Mexico, Taiwan, Germany down 10% over the last 3 months. In India, France, Italy, a lot of these big countries showing some pretty decent losses. There's Canada down 8% over the last 3 months. Again, a victim of that strength in the dollar that we're finally starting to see put some pressure not only on U.S. equities but also on crude oil as well. If you take a look at the sectors now over the course of these past 3 days, you can see utilities and real estate both down a little bit, but holding up okay. There's energy as well. Despite the big drop in crude oil this week, energy had a nice little rally today. And you can see the biggest losers during this past 3-day decline has been communication services, consumer discretionary, and of course technology. That's been the biggest one. If I were to go back out now and take a look at this custom time frame back to where the market peaked, that 2800 peak and the highest near-term high that we've had here recently. Let's go to an hourly chart now. We'll go to a half hour so we can get a little bit of movement in here. Again, technology's down 9%. The market's down 6% from that near-term peak. Technology's down 9%. Discretionary consumer communication services, energy is down there too. Industrials. To the top, you see real estate holding up pretty well. Staples pulling back here recently during this week's decline. See, it's before this week started, we were doing okay on staples, but it's fallen back with everything else. Healthcare and brown also beating the market, but still with about a 3% loss during this decline. Materials in green. This financials here is in yellow. Those are all the other areas that are outpacing during the decline. Of course, previously during the bounce up to that 2800 high on the 7th, you can see materials is what led you higher. It had a 10% drop increase off of that bounce. Consumer discretionary also bouncing up pretty strongly, along with financials doing really well, and healthcare kind of matching up. So not your typical communication services, technology, both those actually lagging the market during that bounce. Of course, utilities, not surprisingly, also lagging, those showing a gain. So if I were to go back, so from that 29th, basically from the 29th all the way to now, so the ups and the downs here, from that low point that we bounced up to 2800, and then we've pulled back. So through the ups and the downs, you can see the market's about flat, so kind of retesting that low point from late October. But you can see not everything's down, right? Discretionary technology, communication services, they're all down 5% on technology, which remember essentially is Apple now. But on the other end of the spectrum, most sectors are actually up, right? And materials and real estate and financials, they're all doing actually 5% for real estate. Healthcare up 2.5% off of those lows, and that's reflected here. When you look at the 12 grid for all these sectors, not all of them are at the at those October 29th lows. There's the October 29th in this area here. Healthcare is not close to that. Utilities is up off of its 3-month lows. So is staples, and real estate's doing pretty well off of that 29th low point in this area. Whereas you have communication services, you have technology down to new lows with an oversold cluster. You have consumer discretionary also forming a little bit of an inverted hammer pattern here yesterday. A Harami pattern on XLE materials also off of its lows. So you can see not everything is down, and you can see where the pockets of strength were during the previous rise and where they will continue to be. You'd expect materials to continue to be an outperformer on any kind of bounce here, especially considering again the cycle of the cycle that we're in. This late stages, you'd expect materials and industrials and energy to lead these more extended rallies, not just a short-term, near-term, 1-week rally, but more of an extended intermediate run. You would expect them to lead it higher. One stock in the consumer staples area actually that continues to show a bearish pattern and actually breaking through the new low today. And again, I don't put a whole lot of stock into this, so I don't want to be aggressively bearish, but it was a pretty decent move on a down day, and there's some down, you can see according to the orange line, there's some room for this to continue to go down, considering that we're breaking through this old high point. A little bit of a fake out move. We tried to get back up above it, and that didn't last, and now we're back down below it. So if you take a look at some of the other charts for Philip Morris, you can see that we have a bearish posture. The intermediate line now is falling here below 50, so we're getting some dark pink shading here. You look at the long-term chart for it, the 1040 crossover. We've been in the bear market for it. It's rolling back down below a falling 50-day moving average. The Bollinger Bands for Philip Morris, you can see pushing the lower band down again, down towards this kind of strong area of support. So we don't need it to be too strongly bearish here, right? But there is going to be some support down there. So, and then finally the DMI. You can see that we've got the crossover and getting back above 25 on the orange line after an extended bullish run here. So an opportunity for the orange line now to make its own extended run up above there. And if you take a look at the rest of this DMI study set, red on the histogram with a red arrow on the stochastic extreme. So bearish pattern there, so an opportunity to sell, a call option around that mid-30s delta. So we'll sell the 86 and buy the 88 for a protection. And again, for those who don't know, that's essentially doing, we are essentially selling the 86 and buying the 87 and getting a pretty decent credit out of that. Selling the 87, buying the 88, and also still getting enough of a credit to justify that. If I were to sell the 88 and buy the 89, now I'm not getting enough credit. So that's why we don't do an 86, 89, because that last vertical in that embedded in that spread doesn't give us enough credit. But these first two do, right? We're getting 31 cents and 27 cents. So as a result, we'll do the 86, 88 and get enough credit for that. We'll probably have to get right around in that area. And of course, when you analyze that, you get pretty decent odds, and then that break even is actually that blue line. So as long as we stay, below this 86 2/3 level, then we profit. Of course, if we get a little bit above it up to 87, then we end up taking a loss roughly equal to what we're trying to get. So we're willing to lose $56 per contract if it does start to rally again, as long as it stays in this level. And of course, if we can get down to that support area, where all that support is, so right around 78 to 80 in that area. So there's 80. So we'll get more than half of our credit in doing so, and that will give us enough just to get out of the trade and move on to something else, especially if we can get that relatively quickly. All right, well, that wraps us up for today. Now I want to hear from you in our Market Outlook forums on marketscholars.com. Remember, there's that link that pops out there that you can click that will take you to our forums. You have to subscribe to our site to participate in them, but you can do that for free. But I'd love to hear what you're thinking. As always, thank you very much for watching our videos day in and day out. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment. Follow me on Twitter for more content like this. Join our Market Outlook community on Facebook that we've created for Facebook, and also on our website on marketscholars.com. Have a great Thanksgiving holiday, everybody, with food and football and family tomorrow. We'll be back at it for a small most likely very low volume session on Friday. We'll take a look at how the market's opening up for next week. So thanks again. Have a great holiday, and we'll see you all next time.